Hi, welcome to our channel of IGNOU audiobooks, Indira Gandhi National Open University, School of Engineering and Technology, SOET, Diploma, Postgraduate Diploma Programs, Postgraduate Certificate in Inventory Planning and Warehousing System for Engineers, PGCIPWS, MWR-01 Introduction to Inventory Planning and Control, Block-1 Basic Concept of Inventory. Unit-1 Introduction to Inventory Planning and Control. 1.1 Introduction. In the past, when buildings were built, workers were laid off if building materials ran out of stock and were called when the materials arrived. Can you visualize the setback such a stock out of supplies of parts or raw materials can cause to a big production unit of today? The losses would be really very high. Similarly, consider that a company which runs out of stock of finished goods and is unable to supply goods to its customers in time. Its customer may go to other manufacturers. Loss of goodwill may also lead to the loss of a number of customers. By reading the above paragraph, one thing must come to your mind, that inventory is an important for any business, and no business cannot function or even exist without it. You must have realized the importance of spare wheel in your car, scooter. You have been provided a provision for reserve petrol in your car, scooter. Therefore, inventory planning and its control is not a new subject for you. In other words, we may say that you are going to study a topic which is related to your day-to-day life. All the units will provide you an insight into inventory planning and its control. You must appreciate that 4 to 6 hours of study is required for each unit for comprehension and for preparing assignments. Now you must be eager to know why we are studying inventory planning and control. What is the need for its control? You must agree that inventory consists of holding large amount of capital. Let us take an example of a company which has a turnover of Rs. 100 crores, and which has an inventory worth Rs. 30 crores. The inventory carrying cost incurred by the company is 9 crore rupees per annum, which is Rs. 2.5 lakhs per day. This expenditure of Rs. 9 crores is neither helping the company, nor helping the customer, or the country. In other words, this large amount of money is only used to maintain the idle capital. It, therefore, stands to reason that inventory planning and control is not essential but also vital for the survival of a company so as to control the stock of goods helped by it. Objectives. After studying this unit, you should be able to define various terminologies used in inventory planning. Classify a given inventory. Explain the need, objectives and functions of inventory planning. Differentiate between different types of demand inventory. Identify various factors affecting inventory. Describe various cost parameters used in inventory, and discuss the need for inventory control in the manufacturing industry. 1.2 Definition of inventory. Inventory is a part and parcel of every facet of business. Without it, no business activity can be performed, whether it is a service organization like hospital, bank etc., or a manufacturing or trading company. Irrespective of the specific organizational setting, inventories are required in a conversion process of inputs to outputs. This is illustrated in Figure 1.1. In fact, inventory is maintained for flow of operations in the production process. Figure 1.1, the materials conversion process. It would be seen that in a material conversion process, Figure 1.1, there are stock points at the input, raw material, conversion, work in process, and output, product, stages. Looking at the conversion process where inputs and outputs are based on market uncertainty, it becomes physically impossible and economically impractical for each stock item to arrive exactly where it is needed and when it is needed. Even if it is physically possible to deliver the stock when it is needed, it may be prohibitively expensive. This is the fundamental reason for carrying the inventories. Thus, inventories play an essential and pervasive role in any organization because they make it possible to get right amount of stock at exact time of need to ensure continuous and smooth production. To avoid the physical impossibility and economical impracticability of getting right amount of stock at exact time of need. To maintain more stable operating or workforce levels. To take advantage of shipping economies. To plan overall operation strategy through decoupling of successive stages in the chain of acquiring goods, preparing products, shipping to branch warehouses and finally serving customers. To facilitate economic production runs. to facilitate the intermittent production of several products on the same facility. To provide means for hedging against future price and delivery uncertainties. To make effective use of available capital and or storage space, and to achieve favorable return on investment. 1.2.1 Objectives of inventory. As inventory is an essential part of any organization, it consists of many items running into thousands. Systematic management and control of inventory for all the items is a challenging job. Main objectives of inventory and its control are: to maintain the overall investment in inventory at the lowest level, consistent with operating requirements. To supply the product, raw material, sub-assemblies, semi-finished goods, etc. to its users as per their requirements at right time and at right price. To keep inactive, waste, surplus, scrap and obsolete items at the minimum level. To minimize holding, replacement and shortage costs of inventories and maximize the efficiency in production and distribution. To reduce the risk inherent in treating inventory as an investment and for others less returns. Inventory and stock are regarded as synonymous in BS 5191 is to 1975. However, its original meaning is list of stocked items. Such stock generally consist of 1. Direct items which is included in the finished product. 2. Indirect items which is not included in the finished product like cleaning materials, stationery, etc. 3. Supporting items directly supporting production like spares for the emergency generator, and 4. Reserved items which are committed to some specific purpose but need not be kept separate from other. 1.3 Functions of inventory. The basic function of inventory is to increase profitability through manufacturing and marketing support. Since zero inventory manufacturing distribution system is not practical, it is important to remember that each rupee invested in inventory should be committed to achieve a specific objective. Other basic function of inventory is geographical specialization, decoupling, balancing supply and demand, and safety stock. 1. Inventory investment alternative. Inventory is a major area of asset development which should be required to provide a minimum return on investment. The margin efficiency of capital, MAC, concept holds that a firm should invest in those alternatives that provide a greater return than capital cost to borrow. Figure 1.2 shows that investment alternative A on the MAC curve is acceptable. The MAC curve shows that 20% of the inventory investment alternatives will give a return on investment above the cost of capital. Every organization is interested in return on investment or return on assets employed. Return on assets is profits divided by assets. In other words, return on capital, assets, equals profits, capital, assets. Equals profits upon sales into sales upon capital equals profits upon sales into sales upon assets. Profit over sales is the profit margin. It depends upon many factors including uncertainties of change. Sales over capital is capital turnover. One way to improve return on investment is to increase turnover or keep the assets in inventory low. Figure 1.2. Typical marginal efficient of capital curve, MAC. Look at the screen. 2. Geographical specialization. Another function of inventory is to allow geographical specialization of individual operating units. Due to factors of production such as power, raw materials, water and labor, the economical location for manufacturing is often a considerable distance from areas of demand. The manufactured goods from various locations are collected at a simple warehouse, plant to assemble the final product or to offer customers a single mixed product shipment. This also provided economic specialization between manufacturing and distribution units of an enterprise. 3. Decoupling. This function of inventory is to provide maximum efficiency of operations within a single facility. Decoupling is done by breaking operations apart so that one operation's requirement is independent of another's. This decoupling function serves two purposes. First, inventories are needed to reduce the dependencies among successive stages of operations so that breakdowns, material shortages, or other production fluctuations at one stage do not need later stages to shut down. Figure 1.3 illustrates this concept in an engineering firm. Since it is possible to continue deburring packing from inventories, even when die casting and drilling is shut down, these operations can be decoupled from the production processes which precede them. Look at the screen. Figure 1.3. decoupling of operations by using inventory. A second purpose of decoupling is to let one organization unit schedule its operations independently of another. For example, in automobile organization, engine build-up can be scheduled separately from seat assembly, and each can be decoupled from final automobile operations through in-process inventories. 4. Balancing supply and demand. Balancing function concerns elapsed time between consumption and manufacturing. Balancing inventories exist to reconcile supply of sugarcane with demand. The most notable example of balancing seasonal production and year-round consumption of sugar. Another example of year-round production and consumption is woolen textiles. Inventories inner balancing capacity link seasonal economies of manufacturing with variations of consumption. The balancing function of inventory requires investment in seasonal stocks which are expected to be fully liquidated within the season. 5. Safety stock. The safety stock or buffer stock concerns short-range variation in either demand or replacement. A great deal of inventory planning is devoted in determining the size of safety stocks. Safety stock provides protection against two types of uncertainty. The first type of uncertainty is sales in excess of forecast during the replenishment period. The second type of uncertainty concerns delays in replenishment. The inventories committed to safety stocks represent the greatest potential for improved performance. A variety of techniques are available to develop safety stocks which can be adjusted rapidly in the event of error or a change in policy. 1.4 Factors affecting inventory planning and control. The major problems of inventory planning and control are two, i.e. A. How much to order, and B. When to order. 1.4 Factors affecting inventory planning and control. The major problems of inventory planning and control are two, i.e. A. How much to order, and B. When to order. A. Purchase price or production cost. The cost, or value of the item is the money paid to the supplier. For the item received are the direct manufacturing cost if produced. It is normally equal to purchase price. When the market prices go on fluctuating, planning for inventory is based on the average price mostly taken as a fixed price. The price factor is of special interest when price discounts can be secured or when large production runs may result in a decrease in the production cost. B. Selling price. In some inventory situations, the demand may be affected by the quantity stocked. In such cases, the inventory model is based on a profit maximization criterion which includes the revenue from selling the commodity. The unit selling price may be constant or variable, depending upon whether quantity discount is allowed or not. C. Procurement costs. These costs are those incurred on a purchase, known as ordering cost, or incurred as setup costs related with the initial preparation of a production system if manufactured. These costs vary directly with each purchase order placed or with the setup made and are usually assumed independent of the quantity ordered or produced. Procurement costs include costs of administration, such as salaries of the persons concerned, telephone calls, computer costs, postage etc., transportation of items ordered, expediting and follow-up, receiving and inspection of goods, processing payments etc. This cost is expressed as the cost per order or per setup. D. Carrying, or holding, costs. The cost associated with carrying of stocks of items is called holding cost or storage cost or possession cost. Holding costs include handling cost, maintenance cost, wages, insurance, safety measures, warehouse rent, depreciation, theft, pilferage, obsolescence, interest on the money looked up, etc. A. Shortage, or stock out, costs. These are penalty costs incurred as a result of running out of stock when the commodity is needed. One form of these costs is known as back order on the selling side, or backlog costs on the manufacturing side, when the unfilled demand can be satisfied at a later date, i.e. customer waits till he gets the supply. Another form of these costs is known as lost sales costs on the selling side, or no backlogging cost on the manufacturing side, when the unfilled demand is lost. It happens when the customer does not wait for the supply and goes elsewhere. See Figure 1.4. These include the costs of production stoppage, overtime, idle time payments, expediting, special orders at higher price, idle machine, loss of goodwill, loss of opportunity to sell, loss of profitability, etc. Figure 1.4. Nature of shortage costs. Look at the screen. F. Cost of operating the information processing system is stock level change. Someone must update records either by hand or by computer, where the inventory levels are not recorded daily. This operating cost is incurred in obtaining accurate physical counts of inventories. Such operating costs are more fixed than a variable over a wide quantity, volume, range. 2. Demand. The demand pattern of a commodity may be either deterministic or probabilistic. In the deterministic case, it is assumed that the quantities needed over subsequent periods of time are known with certainty. This may be expressed over equal periods of time in terms of known constant demands or in terms of known variable demands. The two cases are referred to as static and dynamic demands respectively. Probabilistic demand occurs when requirements over a certain period of time are not known with certainty but their pattern can be described by known probability distribution. In this case, the probability distribution is said to be either stationary or non-stationary over time. These terms are equivalent to static and dynamic demands in the deterministic case. The demand for a given period of time may be satisfied instantaneously at the beginning of the period or uniformly during that period. Instantaneous and uniform demand affects directly the total cost of holding inventory. 3. Ordering cycle. This is concerned with the time taken to build up inventory. An ordering cycle may be identified as the time period between two successive placements of orders. This reckoning of time in two ways. 1. Continuous review, where a record of the inventory level is updated continuously until a certain lower limit is reached, at which point a new order is placed. This is referred to sometimes as the two-bin system. 2. Periodic review, where orders are placed usually at equally spaced intervals of time after periodic review. 4. Delivery lag or lead time. When the need of the material is felt and an order is placed, it may be delivered instantaneously or it may require some time before delivery is effected. The time between the placement of the requisition for an item and its receipt for actual use is called delivery lag or lead time. In general, lead time has four components, viz. Administrative lead time, supplier's lead time, transportation lead time and inspection lead time. While administrative lead time and inspection lead time can be fixed, the supplier's lead time and transportation lead time can never be fixed. In general, the lead time may be deterministic or probabilistic. 5. Time horizon. This is also known as the planning period over which inventory is to be controlled. The planning period may be finite or infinite. Mostly inventory planning in an enterprise is done on an annual basis. 6. Number of supply echelons. There may be several stocking points in the inventory system. These points are organized such that one point acts as a supply source for some other points. For example, the factory supplies the products to warehouse, and the warehouse supplies to the retailer who, in turn, supplies to the customer. Each level is called an echelon in multi-echelon inventories. As illustrated in Figure 1.5, it shows products stocked at the various levels in the distribution system. 7. Number of stages of inventory. When parts are stocked at more than one stage in the sequential production process, they are called multi-stage inventories. 8. Number of items. An inventory system involves, generally, more than one commodity. The number of items held in inventory affect the system when these items compete for limited floor space or limited total capital. 9. Availability of items. Sometimes supply position is badly affected due to various market situations, which in turn affects the inventory system in an enterprise. Figure 1.5, Multi-Echelon Supply System. Look at the screen. 10. Governments, companies' policy. For items to be imported as well as for other items like explosives, highly inflammable liquids and other hazardous items, the government has laid down some rules. Similarly, a company may also lay down certain policies based on available capital etc. All these affect the level of inventories in any organization. All the above factors responsible for the development of inventory system are known as inventory characteristics. Major factors affecting the inventory system are demand, cost factors and lead time. Excepting these two, all other factors can be treated as completely known in an inventory system. Activity 1.3. In the organization where you are working or the one with which you are familiar, Collect the list of materials and list out what factors are affecting each of them. 1.5 Inventory control. A problem which always remains is how much material is to be ordered and when. The manufacturing industry will definitely like to know the quantity of building materials to be ordered at any one time. This quantity of building material is called economic order quantity. Economic order quantity, EOQ. EOQ permits the lowest cost per unit and is most advantageous. Before calculating EOQ, it is necessary to become familiar with terms like maximum quantity, minimum quantity, reorder point, lead point, and buffer stock and stock out. These terms are known as quantity standards. A. Maximum quality. This term is applied to designate the upper limit of the inventory and represents the largest quantity which should generally be kept in stores. B. Minimum quantity. The term is applied to designate the lower limit of the inventory and represents a reserve or margin of safety to be used in case of emergency. When requirements have been fluctuating, there must always be at least this quantity available in stores. The purpose should be to hold enough and not excessive stock of materials so as to 1. Avoid running out of stock, and 2. Create a buffer stock which may be utilized if the material falls below the minimum level. C. Standard order. It is the quantity to be purchased at any one time. Repeat order for a given product are always for this amount until this is revised. D. The ordering point or reorder point. This represents the quantity required to ensure that there is adequate material for the interval between the placement of an order and delivery. When the balance falls to this level, it indicates that a new purchase order must be placed. A. Lead time. Generally, lead time is the time taken for the stock to reach from reorder point to maximum stock level. In other words, lead time is the time taken from the time the requisition for an item is raised till the supplies are received, inspected and taken into stock. Lead time involves the time taken by following activities: requisition inquiries, quotations, scrutiny, negotiations and approval, import formalities, in case of imported items, placing an order, time taken by supplier for making the goods ready, transportation, receipts of goods, inspection, taking the material into stock. F. Reserve, safety or buffer stock. Stated simply, safety stock is so many units of weeks of stock. However, this type of approach does not take account of variation in demand. In fact, if everything is done in the proper order, i.e., in an ideal situation where order is placed exactly at reorder level, the consumption rate remains same and material is received within lead time, then there is no need for reserve or safety stock. But this seldom happens. Therefore, to safeguard production processes against uncertainties in consumption rate and lead time, an extra stock is maintained all along, which is called safety stock, reserve stock or buffer stock. Safety stock level should be decided very carefully, as lower level may lead to stock out position and higher level means blockage of capital. The factors considered for this purpose are 1. Variation in consumption expected during the lead time, and 2. Variation in lead time expected considering the prevailing market conditions for that item. Generally, the safety stock is fixed considering the past data of maximum lead time and normal lead time. Safety stock should then be sufficient to last for the periodic difference between maximum and normal lead time. In setting maximum, minimum and ordering quantities, each item should be considered separately in terms of the following factors: economic quantity of each purchase order, increased lockup of capital, the time required to receive the goods after requisition, the probable depreciation and obsolescence, the rate of demand, etc. In the next unit, economic order quantity will be discussed in detail. SAQ 7. A. What is economic order quantity? B. Differentiate between reorder time and lead time. 1.6 Role of inventory planning and control in manufacturing companies. Imagine running a bakery and suddenly realizing that you do not have enough flour to complete an order for one of your largest clients. As a manufacturer of baked goods, flour is a key component to your end product and is, therefore, a crucial part of your inventory. For all manufacturing companies, making an accurate assessment of inventory means the difference between a profit and a loss. Periodical inventory of the tools, equipment and materials should be taken upon every site to know the exact position and condition of the materials, tools and plant. Its advantages are: Any excess material not presently required can be shifted to other site for use. Before writing any requisition, previous balance quantity may be accounted for and order may be placed for what is needed. Any shortfall or damages to the material can be brought to notice of the higher authorities. Repairs or modifications to storing system can be done if required. Cross-checking of the records maintained by the storekeeper can be done. Consideration of percentage of wastage for various materials can be studied and standardized to avoid excess inventory, and purchasing of material in stages as per production schedule can be followed to avoid additional financial burden due to excess inventory. Efficient management of inventory is the goal of every manufacturer because inventory has a direct impact on profits through an income statement item called cost of goods sold, which is the value of inventory sold for the period. To calculate its gross profit, a manufacturer subtracts cost of goods sold from sales. For example, if sales are $1 million and cost of goods sold, COGS, is $650,000, the company's gross profit is $350,000. From its gross profit, the company subtracts all other operating expenses to derive its net income. Therefore, it is important for a manufacturer to record its cost of accurately. Goods sold. Activity 1.4. In the organization where you are working or the one with which you are familiar, collect the list of materials and classify them according to a lead time and based on that plan the reorder point, minimum and maximum stocks. 1.7 Summary. After going through this unit, introductory concepts of inventory, its planning and control must be clear to you. To provide better understanding of inventory, its need and purposes as also types of inventory and factors affecting them have been described. The basic question, relating to inventory, that is, how much material should be ordered and when, has been explained with the help of illustrations along with economic order quantity, reorder point and lead point. Different models of inventory have not been discussed here. The attempt here is to give you a clear conception of inventory so as to enable you to understand the models which are explained in the next unit. Illustrations have been given in the form of graphs, figures, tables and examples. Thank you. Subscribe to our channel for more updates, and we will see you with the next chapter.